If you're a crypto trader, you know the feeling. That market just never, ever sleeps. But what if the real secret to winning isn't about trading more? What if it's about trading a whole lot less? Well, today we're going to break down a really powerful strategy that's all about finding those perfect, high probability windows in the middle of all that 24/7 chaos. So let's start with a big question, the one that probably keeps a lot of traders up at night. Is this always on 24/7 crypto market actually a trap? I mean, it feels like it should be an advantage, right? Endless opportunities. So why do so many people just get chopped up, hitting their stop losses over and over again? Well, it kind of feels like a trap because, in a way, it is. See, this illusion of constant opportunity, it's one of the biggest hurdles you can face in crypto. The honest truth is that not all hours of the day are created equal, not even close. The market moves in cycles, and it's driven by something that traders in traditional markets, like Forex, have known for decades: market sessions. So, what are these trading sessions? Just think of them as the official business hours for the world's biggest financial centers. London, New York, Tokyo. And even though crypto is supposed to be decentralized, the sheer amount of money moving around during these hours has a massive, massive impact on crypto's trading volume and its volatility. And that brings us to what we can call the low volume problem. You see, during the Sydney and Tokyo sessions, which people usually just group together as the Asia session, the trading volume is really, really thin. There just aren't as many buyers and sellers. And that low liquidity, it leads to these choppy, unpredictable price swings and a much, much higher chance that your stop loss, your safety net, is going to get hit. Honestly, it's a super dangerous time to trade. Okay, so if the Asia session is basically a minefield, how do we avoid it? Well, the key is to learn how to decode the market clock so we can pinpoint the exact sessions that are actually driving the big, powerful moves in the crypto market. And I know what you're probably thinking right now. Hang on. Bitcoin is supposed to be separate from all that traditional finance stuff. So why on earth should we care when a bunch of traders in London or New York are getting to their desks? It's a great question, and the answer is surprisingly simple, but it's absolutely crucial. The connection is just a lot more direct than you might think. What's Bitcoin priced in? US dollars. So when the US dollar is seeing a ton of volatility, which guess what, happens during the busiest Forex sessions, that volatility spills right over into the crypto markets. The two are basically tied at the hip by the currency they're traded in. So this brings us to the two sessions that are the main event for any crypto trader: London and New York. London gets the party started at 1:30 p.m. Indian Standard Time, and you see this huge surge of volume come in. Then at 6:30 p.m. IST, New York opens its doors. And for a few hours, those two sessions overlap, creating the absolute peak of trading activity for the entire day. But here's where it gets really interesting. We can get even more precise, because even within these super high volume sessions, the source material we're looking at pinpoints three specific 1-hour windows where the probability of catching a real significant move is at its absolute highest. These are what we're going to call the 3 golden hours. Okay, so that first window of opportunity, it pops up right after the London session gets going. But here's the trick. You need to wait 15 minutes. Let the initial chaos and manipulation play out first. That little 15-minute buffer brings us to our very first golden window, from 1:45 p.m. to 2:45 p.m. Indian Standard Time. This is the sweet spot when the market has kind of settled into the London session and you're much more likely to see a clear directional move. All right, next up is our second golden hour. Now this one is all about the New York Open, which, as we said, brings the highest trading volume of the entire day. It's a really big deal. And just like we did with the London Open, we're going to apply that same 15-minute buffer. Let the dust settle. That makes our second prime trading window 6:45 p.m. to 7:45 p.m. IST. This hour is often the most explosive one because you've got both the London and the New York markets going full throttle at the same time. And finally, after that initial New York rush, things often calm down for just a little bit. But then a third window, a third period of really significant activity starts to open up. And that brings us to our third and final golden hour, from 8:45 p.m. to 9:45 p.m. IST. According to the source, this is often when the day's volume hits its absolute peak, and that can lead to some really powerful, clear moves in the market. Okay, so now we know when to trade. We have our 3 golden hours. But the big question is, how do we actually trade them? Well, the source provides a really simple, really actionable breakout strategy that's designed specifically for these high-volume windows. Let's walk through this blueprint step by step. It's pretty straightforward. First, you pull up a 15-minute chart, and you find the very first candle of either the London or New York session. Step 2, you just mark the high and the low of that single candle. That's your trading range. Third, you drop down to a 5-minute chart for your entry. Now, if a 5-minute candle closes above the high you marked, that's your buy signal. And if it closes below the low you marked, that's your short signal. Simple as that. Finally, you aim for a 1-to-2 risk-to-reward ratio. Your potential profit should be twice your potential loss. The real secret here isn't some complex indicator, it's all about the timing. Now, any strategy is just a theory until you actually put it to the test, right? So how did this whole framework actually perform under pressure? Well, the source material gives us a 13-day backtest to see if trading only in these golden hours really gives you an edge. So here were the rules of the game. The test ran for 13 days in January. It started with a hypothetical capital of 1 lakh rupees, and for each trade, it only used 10% of that capital, so 10,000 rupees. And the goal for every single trade was that strict 1-to-2 risk-to-reward ratio. So what were the results? Well, here they are. Over that 13-day period, the strategy gave them 7 profitable days against 6 losing or break-even days. Now, this shows you right away this is not some get-rich-quick scheme. You're still going to have losing days. But over the course of this test, the strategy did show a slight statistical edge. And this quote from the source might just be the most important takeaway from this whole thing. This is not financial advice. It's a framework, an idea. Real confidence in any strategy only comes when you do the work yourself. You have to backtest it and see if it actually fits your style and your own risk tolerance. And that's really the final thought I want to leave you with. What if you just ignored all the noise from the 24/7 market? What if you focused only on these 3 high-probability windows? Could you finally have an edge? It's a powerful idea, and it totally challenges that always-on mentality. It suggests that maybe, just maybe, the key to success is knowing exactly when to act, and more importantly, knowing when to just sit back and do nothing at all.